In January 2020, a $400,000 mortgage cost you about $1,455 a month. Today, that same mortgage costs $2,050. Nearly $600 more every month for the exact same house. The house didn't get better. Your income didn't go up 40%. The only thing that changed is the interest rate. And the Federal Reserve has been cutting its own rate this whole time. The government has a plan to push your rates back down. They're buying back their own bonds. The bond market is ignoring them. The Federal Reserve controls one rate, the overnight rate banks charge each other. That rate is 3.63% as of July 2026, down from a peak of 5.33%. The Fed has cut 170 basis points. A basis point is just 1/100%. Over that same period, the 10-year Treasury yield, which is the benchmark your mortgage is priced off of, went from about 4.0% to 4.65%. The Fed eased. Long-term rates went up. In textbook monetary policy, when the Fed cuts, long-term rates should follow. But the textbook assumes the market trusts the government's fiscal path. Right now, the market doesn't. If you think mortgages are bad, look at your credit card. When the Fed rate was near zero in 2021, the average credit card APR was about 14.5%. With the Fed rate at 3.63%, average APRs are above 21%. The Fed went from 0 to 3.63%. Your card rate went from 14.5% to 21%. Banks are pricing in the risk that long-term rates keep rising and that consumers keep defaulting. A quarter-point Fed cut does not move your 21% APR. The government is not oblivious to any of this. The Treasury has been running an expanded bond buyback program. That means they're buying their own older bonds back from the market. The idea is simple. Fewer bonds in circulation should mean higher bond prices and lower yields. On August 21st, 2026, the BBC reported that markets shrugged off the scheme. Edward Yardeni of Yardeni Research told the BBC the problem is straightforward. The US government is, in his words, taxing too little and spending too much. The buyback program is like bailing out a swimming pool with a teaspoon while someone runs the hose at full blast. To understand why it fails, we have to go back to a cautionary tale from 2022. September 2022, the United Kingdom. A new Prime Minister named Liz Truss had just taken office. Her government had a plan, big tax cuts, to stimulate growth. On September 23rd, her Chancellor delivered what they called a mini-budget. It announced roughly £45 billion of unfunded tax cuts. No spending reductions to match. The cuts would be paid for with borrowing. And because it was a mini-budget, not a full budget, it skipped the independent cost analysis that usually comes with fiscal statements. The bond market was about to have an opinion. UK government bonds are called gilts. The 10-year gilt yield was about 3.1% before the mini-budget. Within days, it spiked to over 4.5%. The 30-year went from 3.5% to nearly 5.0% in less than a week. This was not a gradual repricing. It was a panic. Pension funds that held gilts faced margin calls they couldn't meet. They were forced to sell into a falling market, pushing prices down and yields up further. Classic doom loop. On September 28th, just 5 days later, the Bank of England announced an emergency bond buying program. The central bank was undoing the fiscal policy of the elected government because the bond market had rejected it. Governor Andrew Bailey said the intervention was necessary to prevent, in his words, a material risk to UK financial stability. Truss fired her Chancellor on October 14th. His replacement reversed nearly all the tax cuts. Too late. On October 20th, 2022, Truss announced her resignation. She had been Prime Minister for 44 days, making her the shortest-serving PM in British history. The gilt market had effectively vetoed a fiscal policy, and the Prime Minister was gone. The Truss government didn't intend to trigger a meltdown. It believed tax cuts would stimulate growth and the bond market would accept the borrowing. The bond market disagreed, and the bond market won. Bond markets can defeat governments. When investors believe a government's fiscal path is unsustainable, they sell bonds which pushes yields up, which raises borrowing costs, which makes the fiscal path even less sustainable. The US is not the UK. It has the world's reserve currency, the deepest bond market, and a far larger economy. But the mechanics are the same. The US national debt just passed $40 trillion, doubling in about a decade. The Treasury is running expanded buybacks while the government runs large deficits. Investors are demanding higher yields to hold US debt, just as they demanded higher yields to hold UK debt in 2022. The UK crisis took 44 days. The US version is a slow-motion version of the same process, playing out over months and years. If this is making sense, hit subscribe. Now let's look at what the Treasury is actually doing about this. The Treasury's buyback program works like this. The government issues new bonds to raise cash, then uses some of that cash to buy back older bonds with poor liquidity. The stated purpose is to improve liquidity in the Treasury market. The program started in 2024, the first sustained buyback program since the early 2000s. As yields kept rising, the program was expanded. Buybacks should reduce the supply of bonds, pushing prices up and yields down. If the Treasury buys back $10 billion of old bonds, there are $10 billion fewer bonds out there. Basic supply and demand. But the Treasury is simultaneously issuing new bonds at a far greater pace to fund the deficit. The deficit is approaching $2 trillion per year. The buyback is a rounding error. The US national debt surpassed $40 trillion in 2026. It has doubled in roughly a decade, from about $20 trillion in 2017. The interest alone on that debt, at current yields, is approaching $1.6 trillion per year. That is one of the largest single-line items in the federal budget. Every 0.01% increase in the 10-year yield adds roughly $30 billion to annual debt service costs over time. As yields rise, the government's interest costs rise. More interest means more borrowing, which means more bonds, which means higher yields. This is the same dynamic that destroyed Liz Truss, just in slow motion. To understand why the government can't control your rates, you need to know who actually sets them. Long-term interest rates are set by a global market of buyers and sellers. Foreign central banks, pension funds, insurance companies, hedge funds, and individual investors. The US Treasury market has about $27 trillion in marketable debt. Japan holds roughly $1.1 trillion in US Treasuries. China holds about $780 billion. Both have been reducing their holdings. Meanwhile, the Federal Reserve holds about $4.3 trillion in treasuries, down from over $5 trillion. The Fed has been letting bonds mature without reinvesting, a process called quantitative tightening. The Fed was the biggest buyer of treasuries during the pandemic. Now it's a net seller. The Treasury has to find private buyers for all the new debt, plus the debt the Fed is letting go. The data tells the story clearly. The 10-year Treasury yield was 4.21% in January 2026. By August, it hit 4.65%. That is a 44 basis point rise in 7 months, during which the Treasury was intensifying buybacks. The 30-year Treasury yield is at 5.19%, near its highest level in 20 years. The 20-year maximum for the 30-year is 5.35%. We are close. Now look at mortgages. The 30-year fixed mortgage rate has climbed every single month in 2026. January 6.10%, August 6.65%. No reversal. Over 30 years, that is more than $257,000 in additional interest on a $400,000 loan. The house is the same. The loan is the same. The bond market changed the price. The yield curve tells its own story. The spread between the 10-year and 2-year Treasury yields was deeply inverted through 2023, a classic recession signal. In 2026, the curve has normalized to a positive slope. The Fed funds rate at 3.63% is below the 10-year yield of 4.65%. That positive spread normally signals growth. But it is being driven by rising long-term yields, not falling short-term rates. The market is not pricing in a boom. It is pricing in fiscal risk. And this is not just a US problem. The BBC reported on August 19th that global borrowing costs hit fresh highs across US, UK, German, and Japanese debt. The US competes for capital with every other sovereign issuer. The Fed can control the short end. The long end belongs to the market. If rates keep rising, what breaks first? The most immediate risk is housing. Mortgage rates at 6.65% have frozen the market. Homeowners who locked in 3% rates during the pandemic will not sell and take on a 6.65% mortgage. This creates a supply shortage that keeps prices high even as rates rise. The worst of both worlds for buyers. The median existing home price remains above $400,000. At 6.65%, the monthly payment on a median-priced home is over $2,500. That requires an income of roughly $100,000 just for the mortgage, before property taxes, insurance, and maintenance. The second risk is commercial real estate. Office buildings and shopping centers are financed with mortgages that come due every 5 to 10 years and must be refinanced. A building financed at 3.5% in 2019 must now be refinanced at 6.5% or higher. For many properties, the rental income cannot cover the new debt service. Regional banks hold about 70% of commercial real estate loans. A wave of defaults could trigger a banking crisis like the one in March 2023, when Silicon Valley Bank, Signature Bank, and First Republic all failed. The third risk is fiscal dominance. If the debt burden gets large enough, the Fed could be forced to keep rates low, not because inflation is low, but because the government cannot afford the interest payments. The US is far from that scenario, but the trajectory is concerning. So what should a normal person do? First, stop waiting for rates to go back to 3%. The 10-year yield has been above 4% for most of 2025 and 2026. Plan around 6 to 7% mortgage rates. Second, if you have variable rate debt, pay it down or refinance to fixed. Credit card rates above 21% are not going to drop meaningfully, even if the Fed cuts further. Third, if you are buying a house, do not bet on refinancing in 2 years. Buy a house you can afford at 6.65%, not one you can only afford at 4%. Fourth, if you have savings, take advantage. Treasury bills and money market funds are yielding around 5%. The government can't control rates, but you can benefit from the rates the market has set. The Treasury is buying back bonds. The Fed has been cutting. Your mortgage is 6.65% and rising. The 10-year yield is 4.65%. The 30-year is 5.19%, near a 20-year high. The government is trying to push rates down. The bond market is pushing them up. The market is winning. Watch one number, the 10-year Treasury yield. When it goes up, your rates go up. Team government or team bond market? Drop it in the comments and subscribe.